in the meantime, a $5.5 trillion with a T mortgage market is failing, literally. As the Fed buys up those mortgages, the banks are failing to deliver those bonds. For more on this real complex relationship and what it all means to millions of U.S. homeowners, let's check in with our bond expert, Brian Liu. Brian?
Yeah, Lori, we're talking about the quantitative easing program. Everybody knows that the Fed has gone out and bought over $1 trillion of mortgage and agency-related securities, not including the $300 billion of treasuries alone. So what they're doing with that market is they're compressing that market, and the process of that could have major ramifications in terms of volatility of the cost of your mortgage, being able to refinance your home. All these things that are in play with the mortgage market are definitely in trouble. So when you talk about what that implication is, let me explain very briefly. Well, they're buying all these bonds from the Wall Street. Now, dealers are failing to deliver these bonds. So you'll see the failure to deliver these bonds, meaning like buying a home and then refusing to have the previous homeowner move out of the house. So the Fed is not actually getting a lot of these bonds to the tune of $100 billion. So the question is, what does this mean for the market? What are the implications? I talked to a lot of strategists out there. Barclays Capital, they remain negative on that level there. You also talk about the fact that some of the bonds may not be delivered, and the cost of that mortgage could be tight or actually raised because as a result of that. However, Citigroup, they still are very positive on this level of being able to buy mortgages. The fact that half of them are the money managers who traditionally would buy a lot of these mortgages, they're buying less than half of it than they used to. They could go back into the market once the Fed comes out.